Okay, so you know that feeling when you're reading something and suddenly all the pieces just click? I recently read The Psychology of Money, and I realized everything that happened in 2008 wasn't really about economics. It was about how our brain actually works when it comes to money. And today, I want to share with you the 7 most important insights. Not abstract theories, not some Wall Street magic, but exactly how they showed up in the biggest financial crisis of our lifetime. But first, a story that gave me chills. Kent Evans. You've probably never heard of him. Kent met Bill Gates in 8th grade, and Gates himself admitted Kent might have been the smartest kid in their generation. Just as passionate about computers, just as ambitious. Together, Kent and Bill had planned to start a software company. Kent was supposed to be the co-founder of Microsoft. But Kent died in a climbing accident before even finishing high school. The probability of dying in a climbing accident? 1 in a million. The probability that Bill Gates would have access to a computer in the 1960s, when there were only a few thousand in all of America? Also 1 in a million. The same astronomical luck, the same force of destiny. Only one of them built Microsoft. The other buried a dream. Let me tell you about 2 guys I met in crisis documentaries. The first, a 28-year-old trader at Goldman. Let's call him Jake. He entered finance in 2003. And between 2003 and 2007, the market went up every single year. For Jake, that wasn't a statistical anomaly. It was physics. It was gravity. It was simply how the universe worked. The second, a man in his 50s sitting in the exact same office. Let's call him Marcus. He had lived through the crash of '87, the Asian crisis, the dot-com bubble, same office, same screens, same data. Jake looked at the charts going up and thought another opportunity. Marcus looked at the very same charts and felt a knot in his stomach. Neither of them was stupid. Neither of them was a genius. Each one was a prisoner of his own experience. And here's the fascinating part. You cannot outgrow your experience by willpower. It is literally wired into your brain. A child who grows up in poverty will always have a different relationship with money than one raised in abundance, not because he chooses to, but because his neurons wired differently in those first years of life. A trader who has only seen growth for 5 years will always take more risks than one who has lived through 3 crises. Not out of stupidity, but out of biology. In 2008, Jake lost everything, not because he was less intelligent, but because his experience didn't include the scenario, everything can collapse. Marcus survived, not because he was clairvoyant, but because his experience included, I've seen this movie before. We are all products of our experiences, and that is not a metaphor. It's neurology. 2, the 1 millimeter that changes everything. Luck versus risk. This one will really surprise you. You know Bear Stearns, an 85-year-old bank, gone in just 72 hours in March 2008? Everyone knows why it collapsed. Too much leverage, bad management, subprime exposure. But let me show you something that might flip everything you thought you knew. JP Morgan Chase, March 2008. Leverage, 33-1. Subprime exposure, massive. Strategy, aggressive. Bear Stearns, March 2008. Leverage, 33-1. Subprime exposure, massive. Strategy, aggressive. One survived and bought the other. for just $2 a share. The difference? On March 10th, a rumor spread that Bear Stearns had liquidity problems. Within 48 hours, every client pulled their money, a self-fulfilling prophecy. JP Morgan, no rumor, no panic. They sailed through the exact same storm. The lightning just happened to strike in the neighbor's yard. Now, this doesn't mean Bear Stearns didn't have problems. They did. But so did JP Morgan. So did Lehman. So did Merrill Lynch. So did everyone else. The difference between hero and victim was timing. Pure luck. After the crisis, Jamie Dimon, CEO of JP Morgan, was called a genius, a visionary, banker of the decade. Jimmy Kane, CEO of Bear Stearns, was called incompetent, greedy, irresponsible. Same people, same decisions, opposite outcomes. 1 millimeter to the left, and Dimon would have been unemployed, while Kane would have been the hero. That is the razor-thin line between luck and risk. They are the exact same force, except one makes you a billionaire, and the other destroys you. 3. The most expensive word in the dictionary. More. Raj Gupta. Does that name sound familiar? Director at Goldman Sachs, friend of Bill Gates, personal fortune, $100 million. 100 million. You could live off the interest of the interest and still have more money than you could ever spend. So what did Raj do in 2008? Oh, just passed along some insider tips to make a few million more. He ended up in prison. He lost everything. His reputation, his freedom, the respect of his family. For what? To move from 100 million to 110? But Raj is nothing compared to Dick Fuld at Lehman Brothers. In 2007, Lehman reported record profits, $4.2 billion. Any normal person would say, wow, let's consolidate, let's reduce risk, let's protect what we already have. Dick Fuld said Goldman made $11 billion. I won't stop until I beat them. So what did he do? He raised leverage from 25 to 1 all the way to 44 to 1. For context, at 44 to 1 leverage, a drop of just 2.3% wipes out everything. That's like driving 200 miles per hour on ice because you want to arrive 5 minutes earlier. September 2008, Lehman Brothers. 158 years of history, gone. Fuld personally lost $1 billion in stock. Stock he could have sold a year earlier. Why didn't he? It'll be worth $2 billion next year. Instead, it was worth $0. Morgan Housel has a line that stayed with me. There is no reason to risk what you have and need for what you don't have and don't need. Fuld had everything he needed. Gupta had everything he needed. But the word enough didn't exist in their vocabulary. Meanwhile, Warren Buffett in 2008 was sitting on $44 billion in cash. Everyone laughed at him, saying he was missing opportunities. You know what he did with that money? He bought half of corporate America at bargain prices, while everyone else was bankrupt. The difference? Buffett knew when to say, I have enough for now. 4. The invisible magic that works both ways. Question. Why is Warren Buffett so rich? Predictable answer. Because he's an investing genius. Real answer? Because he's been investing since age 11. And he's still alive at 93. Look at this. At 30 years old, 1 million. At 50, 376 million. At 60, 3.8 billion. At 93, over 100 billion. 99.7% of his wealth came after he turned 50. Not because he suddenly got smarter, but because time makes math look like magic. But in 2008, we saw the other side of that magic. AIG. Founded in 1919, 90 years of steady growth. It had survived 2 world wars, the Great Depression, 17 recessions. Between 2005 and 2007, its financial products division sold insurance on mortgages, small but steady profits. Joseph Cassano, the head of the division, said, it's free money. The chance of every mortgage failing at the same time is 0.15%. September 2008, AIG needed a bailout of $182 billion, the largest rescue in history. 90 years of growth evaporated in 90 days. Why? Because they forgot that exponential math works in reverse too.
Lose 10%? Then lose 10% of what's left, then again and again.
After 7 of those losses, half of everything is gone. That's exactly what happened to the entire economy in 2008. Rick Guerin, the third founding partner of Berkshire Hathaway, just as smart as Buffett. The difference? Guerin was in a hurry. He used leverage to make money faster. In the crash of 73, 74, he was forced to sell his Berkshire stock for $40 a share. Those same shares today, $500,000 each. Guerin lost $12 billion because he didn't have patience. Buffett made $100 billion because he did. Time in the market beats timing the market, always. But it works both ways. If you run out of time, the market takes you out, permanently. 5. The wealth you don't see versus the wealth you see too much. Do you remember 2006? Everyone was buying houses. Not small homes, mansions. McMansions with 7 bedrooms for families of 3. How could they afford it? HELOC, a home equity line of credit. Basically borrowing money on a house you already owed money on. I found the story of a guy named Casey Sarin, 24 years old, 8 houses in 4 different states, 0 down payments, $2.2 million in debt. He called himself a real estate investor. He even had a blog where he gave financial advice. By 2008, homeless and in prison for fraud. At the very same time, Ronald Reed, an auto mechanic from Vermont. He wore the same jacket his entire life, drove the same '87 pickup, ate at the same local diner. When he died in 2014, he left $8 million to his local hospital. Nobody knew he had that money because real wealth is invisible. Morgan Housel explains it perfectly. When you see a Ferrari, you don't think, wow, that driver must be amazing. You think, if I had that Ferrari, people would think I'm amazing. You admire the car, not the driver.
And in 2008, when credit suddenly vanished, we all saw who had been swimming naked.
The doctor with the BMW, repossessed. The lawyer with the yacht, foreclosed. The entrepreneur with the penthouse, evicted. Meanwhile, the people with real money, the retired teacher with $500K in savings, the electrician with a paid-off home, they were the ones buying everything the rich were forced to sell at half the price. Real wealth is not what you show. It's what you choose not to buy, even when you could.
6. Why 2% can mean the difference between life and death. Okay, this is the technical part, but stay with me because it's crucial. Long-term capital management, 1998, a hedge fund run by 2 Nobel Prize winners in economics, the smartest people in finance. Their model said the chance of us losing money is smaller than the chance of an asteroid hitting Earth. Their leverage? 250 to 1, which means for every one of their own dollars, they borrowed 250. The risk, a loss of just 0.4%, would wipe them out completely. 4 months later, bankrupt. And they almost brought down the global financial system.
Fast forward to 2008. Lehman Brothers leverage 44 to 1, margin of error 2.3%. Bear Stearns 33 to 1, margin of error 3%. Goldman Sachs 22 to 1, margin of error 4.5%. That tiny difference of 2%, Goldman survived without government help. The others, they died or needed a bailout. Benjamin Graham, Buffett's mentor, said it best. The purpose of a margin of safety is to make prediction unnecessary. You don't try to guess the future. You make sure you survive, no matter what happens. And in 2008, Berkshire Hathaway, Buffett's company, looked like this. $44 billion in cash, 0 debt. More than 20 businesses still making money, even in a recession. Everyone said, inefficient, lazy, missing opportunities. Buffett replied, I'd rather miss a 50% gain than risk a 50% loss.
And when everything collapsed, guess who had the money to buy? A margin of safety doesn't make you rich. It keeps you rich.
7. Why irrational people survive and geniuses don't. The last and maybe the most important lesson. Harry Markowitz. Nobel Prize winner for modern portfolio theory. Literally, the man who invented the mathematical formula for the perfect portfolio. And yet, Markowitz's personal portfolio, 50% stocks, 50% bonds. A journalist asked him, "Why don't you use your own formula?" Markowitz replied, "I imagine the regret if the market goes up and I'm not in it, or if it goes down and I'm too exposed. 50-50 minimizes regret. It doesn't maximize profit." The Nobel laureate ignored his own Nobel formula because he was human, not an equation. I found a story from October 2008. Michael, 34 years old, a trader at Merrill Lynch, 2 young kids. In September, his portfolio was down 25%. The models told him, hold. By October, it was down 45%. His wife was crying every night. Michael said, "I sold everything, not because it was smart, but because otherwise I was heading for divorce." He sold at the bottom. He missed the recovery. Mathematically, the worst possible decision. But you know what? He's still married. His kids still have a functioning father. Ray Dalio, one of the most successful investors ever, put it this way: "I'd rather be alive and wrong than dead and right." That's the fundamental difference 2008 revealed. The perfect strategy on paper means nothing if you cannot follow it emotionally. A reasonable strategy you can stick with always beats a rational strategy you abandon in panic. The conclusion that changed everything for me. Charlie Munger, Warren Buffett's partner, once said something that hit me hard. The first man who learned not to touch a hot stove was a genius, but everyone else who learned from his story without burning themselves was just as smart. 2008 was the hot stove of our generation. You don't have to lose everything to learn the lessons. Dick Fuld lost $1 billion to learn about greed. You can learn for free from his story. Bear Stearns died to show what happens when you have no margin of safety. You can learn that lesson without dying financially. The next crisis will come, maybe 2025, maybe 2030. Doesn't matter when. What matters is that now you know. Your experience is not universal reality. Luck and risk are the same force. Enough is the most important word in finance. Time creates miracles, or disasters, depending on your patience. Real wealth is invisible. A 2% margin of safety can mean survival or death. And reasonable always beats rational when panic sets in. The next crisis won't ask how smart you are. It will ask, did you learn from 2008? Or will you have to touch the stove yourself just to believe it burns? The choice is yours.